Introductions. We have some more people here from the bank, and all kind of in the back. Justin Colton, he's in our Festus branch. He's a loan officer. Doug Weber, he's in our DeSoto branch. He's a loan officer. We have Melissa Swigert. She's with First State Financial Management. She's in our Imperial office, and everybody knows Ed. Ed's been here the last 2 times, and he's out of our Imperial office. He's our senior lender. We have Kevin Boren, our president of our DeSoto branch. And of course, myself, I'm Rick Francis. I'm the market president for Jefferson County. And I kind of go with what we had talked about the last 2 times. We've learned a lot, and I think we've had a couple of enlightening sessions. And moving on to the 3rd one, which is we have Craig Sutherland, who's with us. And Craig is a senior vice president, corporate credit officer. And so he's going to share some really important information, kind of let you know what all those numbers are about. And you think, how important the numbers are and what they mean to you and what they would mean to you in the future if you ever want to do any borrowing, or exactly how your business looks when it comes to the financial end of it. Before they do that, you're probably sitting thinking, why would we spend the night doing that? And I'll kind of tell you, this kind of starts with Kevin and myself and Ed. Went out on a camping trip, and we're on our way back, okay? And when we're on our way back, it starts getting real foggy, so we got to find a place to stay. So we see a Motel 6 over there, and we say, okay, we're going to stay in this Motel 6. We can't drive anymore, it's too dangerous. So what we're going to do is we're going to put this, we're going to stop, and it can't cost very much, a Motel 6 in the middle of a foggy night, so everybody throws in $10, okay? So if you kind of picture this in your mind and just kind of keep track, each of us throw in $10, and we go in. And I go into the night attendant, and I just said, we need a room for the evening. It's too bad to drive. So we everybody puts in $10. So with 3 of us at $10, how much is that? $30. So we should get us a room for $30. And we go in, and we're probably the only customer they have that night. So they said, we'll give you the room for $25. Okay? So I'm all excited. I said, okay, we got even a deal. We don't have to. And I said, we need 2 single beds and a rollaway. And they said, that's $25. I go, what a deal. So I give them the $30, and they give me 5 back, and they give me 5 ones. So I said, okay, I can't split $5 in between 3 guys. So what do? I said, I'll just give the night attendant a $2 tip. So anyway, I go back and I say, we got this for $25. Each of us get $1 back. Everybody on board? So how much did everybody give? $9. There you go. So we had $30, and each of us gave 9. So 3 times 9 is what? 27. How much did we give the night attendant? We got $29. Now, we've already lost $1 somewhere. I don't know. That's why you have Craig. So he's going to tell you how important it is to watch your money, because you can see it disappear right in front of your eyes. Now, you're going to think about that all night. You're not going to lose any sleep on it, but I just, that's why we have Craig here. Let's welcome Craig and let him share some of his insight and knowledge about the financial end of your business. Okay?
Well, thank you very much, Rick, and thank you everybody for coming tonight. First night of the World Series, and you're actually here. Thank goodness for me that the Cardinals didn't make the World Series. but welcome to Financial Management for Small Businesses. We're going to be discussing the business aspect of running your business. As business owners, we are all experts. We can perform that service. We can manufacture that widget. We could wholesale some of the products. We become experts on performing that task. But the one thing that most small businesses fail in and struggle with is the business aspect of it, is understanding the financial numbers, within your business, and really use those financial numbers and some of those performance and those statements as management tools for you to be more efficient and more effective in running your business, so that you're able to achieve some of your goals and some of the growth aspects of it, and providing the livelihood that you're looking for. So hopefully we're going to have a little bit better understanding at the end of this evening of the numbers behind your business. And again, I've been lending to small business people and self-employed individuals for about 30 years now. I love reading financial statements. I'd rather read a financial statement than I would a novel. I'm just that kind of weird person. I'm not an accountant. I'm not that weird, but I'm on that line, you know. But you know, kind of keep in mind as you're developing your business and as you're operating year in and year out, each year you're writing a new chapter to your business. And by the time we get to that end of that novel, or we get to that point where you're ready to retire or sell your business or move on, that this isn't, you know, a horror movie. It's a nice, you know, ending. You know, be sure that you know how you write the ending to your own book. But let's make this your session. Honestly, I tell everybody, you know, rely on the experts. Let the experts do what the experts do. Teaching is not my expertise, so I apologize up front. I won't quit my day job, but this is going to be a lot more meaningful if we're engaged in dialogue. So if you had some questions, if you want to try to personalize it to your business and how that may affect your business, please let's have that type of dialogue. I'd rather use real examples versus my examples. Okay? So let me kind of figure out how to. Oh man, that's slick. So what are our objectives? You know, after tonight, what will you be able to do? Hopefully we're going to explain the concept of financial management and the importance to a small business and its owner. We're going to identify financial management practices, rules, and tools commonly available to small businesses. But more importantly, we're going to explain how those financial management practices, rules, and tools actually work. We're going to hopefully leave and give you something that you can take back with you and you could actually start implementing those processes. We are going to explain some of the financing basics for a small business, which includes startup financing, financing for a growing business. Everybody will raise their hand if you want to grow, right? If you don't grow, you're not going to succeed, right? But there's a right way and a wrong way to grow. We'll hopefully talk about that. We're going to finance working capital. We're going to try to describe and explain working capital and why working capital is important and really the proper structure of financing working capital. And we're going to finance fixed assets. A lot of times we have to have some equipment or we need to have some brick and mortar, some type of long-term assets to be able to conduct our business. Some of the benefits, now this is really interesting, some of the benefits to financial management to reach your goals and making good decisions is that you got to know your profitability. Profitability is the most important aspect of business, right? Keep that in mind. I want to ask that question tonight. If I forget to ask that question, Rick, then remind me. I want to re-ask that question. Profitability is the most important aspect of business. We got to forecast your growth, right? We all have to grow. If we don't grow, we're not going to be successful long term. We have to plan for diversification, new product lines, and reaching new markets. A lot of times that helps us to be able to grow if we do those items. And we got to prepare for the financing. You know, we'd love to be able to be in a situation where you provide your own capital, but that's not realistic in today's economy and environment. So you're going to have to rely on some external financing, i.e. loans. So where do we get started? You got to get started at some of the very basics. And I think the very first thing that we need to do is talk about and understand the budgeting aspect of small business. So let's talk about some review points pertaining to the budgets. I'm actually going to put all three of these bullets on here if I can. 4 bullets. All right. Creating a budget is obviously the first place we need to get started with our financial management practice. You know, a budget is a list of all your monthly and quarterly revenues and expenses. And we're going to organize that to make sense in what's relevant for you to track within your own business. Depending on what type of business you're in, you may be wanting to track different items. So you got to personalize that to your individual business. So you want that to be definitely a workable means of managing an income statement. Okay, and we're going to be talking about different types of statements. So really a budget, when we talk about revenue and expenses, we're talking about an income statement. And with a budget, we really want to look at those items more frequently than once a year. Okay, we need to be looking at those items at a minimum, probably monthly or quarterly. And we should be flexible so that we can modify some of those aspects as well. Once you create a budget, you know, we need to compare that budget to what your actual sales and expenditures are periodically. Again, I recommend at least quarterly. And does those actual results, you know, warrant to revise that budget? That budget needs to be dynamic. It needs to be adjusting. And in order to do that, we recommend that you have at least a rolling 4 to 6 quarter budget. So we're actually forecasting revenue and expenses, you know, let's say on a quarterly basis, at least a year to a year and a half, maybe even 2 years, depending on your business type, out in the future. You know, especially 2 years or even a little bit longer if you're anticipating to grow. And how are you going to be able to accomplish that growth? But what we also want to practice is that within that current budget period, we want to replace that with your actual sales and your actual expenditures. How close were you actually budgeting? How realistic were those budgets? Do we need to make some adjustments? You know, was there a new competitor to come in? Was the competitor close down? What some of the external factors may occur that would adjust your actual results? And then you need to look at your budget again and keep revising. It's again a dynamic. It's a management tool. We need to use some of these numbers to manage your business. That's why it's called financial management. It's very, very key. So when we're just talking about that, you need to ask yourself some important questions when completing a budget. So for example, is my business seasonal or cyclical? Anybody describe to me what a seasonal business is? Anybody want to take a shot at that? Christmas trees. Very good example. Why is that seasonal?
Because you only buy it once a year.
Only buy them on Christmas, right? So if you're out here trying to make a living and selling Christmas trees in July, unless you have a Christmas in July sale or something along that line, you're not going to have a whole lot of revenues in July, are you? It's extremely seasonal. Very good. What about cyclical? By the way, that's exactly right on the seasonal side. There's going to be busier versus slower times throughout the year. What about
It could
cyclical?
be retail, couldn't it? Could retail?
Retail definitely is cyclical. There's two, and they're retail businesses, industries that are very cyclical. Matter of fact, when you hear about and talk about the economy, national economy, you know, a lot of these two industries are very commonly referred to as if the economy is good or bad. Well, what do you think those two industries might, what do you hear? Real estate, home sales, right? When the economy is going down, home sales go down. You know, one of the early indications say, hey, the economy is getting better. Home sales are up 3%. Car industry, auto industry, very same thing. They're the early indicators of a cyclical type of business. They're directly tied to the economy. Whenever the economy is better, those industries are better. When the economy slows, they slow. Do you really want a cyclical business? You prefer not to have one, but you know, that's a lot of times that's the nature of the industry. You don't really sometimes have a choice of even having a seasonal or a cyclical business. What about a counter-cyclical business? Any example of a counter-cyclical business? What that may be? I'm sorry? Medical? Yeah, maybe. I mean, but you know, when people get sick, they kind of get sick. And I think there's a better example. What about the rent-to-own industry? You know, whenever the economy is slow, their business is strong because people may not have the resources to go out there and buy a new washer and dryer, but I could rent one on a weekly rental rate. So what happens to their business whenever the economy starts getting stronger? It gets a little tougher. So it's important to know and understand your business, and is your business, you know, seasonal or cyclical, and what's the natures and dynamics behind that. That's again goes straight into your into your forecasting and your budgeting type of process. All right, we kind of talked about this a little bit. You want to kind of personalize your budget. It's recommended to have it rolling 4 to 6 quarters. And please, 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 once you set that budget, don't say, I gotta meet that budget no matter what. You gotta use that budget as a management tool, and you gotta position yourself to be able to adjust and be flexible within your budget. You're not kidding anybody but yourselves by being overly optimistic or overly pessimistic. You want to be as reasonable with that forecast and with that budget as you can. Maybe slightly conservative, but you want to be as realistic as you can. So
What's rolling?
rolling means that let's just use a calendar year. Let's say that I'm January 1 and I want a budget for the next 6 quarters. Okay, so that's basically 18 months. And so I put together a budget for period January 1 through March 31st, and I'm building on that from April 1st to June 30th, and for 6 of those increments of time. Well, when it comes March 31st, what I'm going to do, I'm going to replace that March 30th, that first quarter budget with my actual numbers. I'm going to kind of compare that, hey, am I on track, or do I need to make some adjustments? But then I'm going to add another quarter at the other end. So I'm always looking out at least 4 to 6 quarters. I'm always looking out a year and a half at a time. So even though as time rolls by, I'm replacing that projection, that budget, with my actual results, but I'm also tacking on another quarter at the end. So I'm always out there a year to year and a half into the future. If you don't look into the future, you're going to miss some opportunities, and you're going to miss some potential financial struggles that you may be able to forecast and catching if you monitor those budgets, or you may miss some financial opportunities that, boy, if I kept that up and that rolling budget, I could have made some adjustments and took advantage of some opportunities. So that's what I mean by rolling.
So when you
is
get
that it
to-
should be continuing.
So when you get to the first quarter in March, then you're looking ahead to the
It'll be September of the following year.
September the following year.
Mhm. Yeah, and then when I get to June of that first year, I'm budgeting all the way out to the end of that next year, until December 31st. At least a year. I'd recommend actually 18 months, because again, it kind of goes into play. Is your business seasonal or is it cyclical? And you need to be kind of forecasting on what the economists are saying of what your business or if it's seasonal, definitely you need to manage your cash flows, as we'll get to here in a little bit, for those on seasons versus off seasons. So in your handout, you got it, not your slide handout, you should have another little packet. You should have on the front page, it's called the budgets. It should have a little yellow strip across the top of it. So let's kind of take a look at a typical budget. And again, across the top is different periods. I got 1 through 12, so that could be monthly. But you can also make that quarterly, whatever is a good management period for yourselves. If your business is more seasonal, I would recommend more of a monthly one. If it's not seasonal, I think quarterly is generally just fine. But then on the left-hand side of it, you have different categories, and it starts with revenues. Okay, revenues we'll find out a couple different times. Is this sales? Is that that revenue, that income that you're generating by providing that goods or services? And then we have inventory. Inventory that should be inventory purchases is what are you going to be having to purchase inventory weekly, or some businesses may be purchasing inventory on a monthly basis or a quarterly basis, so you want to kind of budget when you have to come and purchase that inventory. And then all those items below that is just examples of some operating expenses. And again, you want to personalize that. Do you need to track 100% of them? Well, probably not. You want to, maybe track all the major ones, but, the significant ones, and put some of the minor ones in as more of a miscellaneous column. But again, make this your tool. What do you need to track? Personalize it. Okay? So the budget really only monitors the income statement. We said that a little bit before, right? And the income statement will, go a little bit more in depth here in a little bit, but basically it's that revenue versus expenses. What are some other important statements that we need to keep in mind, and that we're going to find out more and more about as we work through this evening? I'm getting ahead of myself a little bit, so I apologize. But it's important as we work through this and have the mindset that Yeah, we're gonna be talking a lot about the income statement tonight. A lot about the income statement. We're also gonna be talking about the balance sheet. And really the home run tonight is understanding the cash flow statement. And coming back, the question that Rick's gonna ask us again at the end of the night. Is net profit's the most important aspect, of your business? We'll see what the answer is at the end of the night. But the aggregate sum of all three of those statements is your financial statement. And that's probably the most common error, mistake that most individuals and small business people make when their banker or somebody asks them to say, hey, I need to get your financial statement. 9 out of 10 times, they'll provide them with generally just a balance sheet, and sometimes on the business side of the balance sheet and the income statement. But really that statement of cash flow is that third statement that most people forget about, and it's an important statement. So we need to keep the balance and the understanding of those three statements, which is really the key to success there. Okay. So moving on to our next section, which is the profit and loss statement. So what is a profit and loss statement? What's another name for a profit and loss statement? It's your income statement. Your income statement and profit and loss statement is all one and the same. We're throwing out a little bit different name because a lot of people, well, hey, I need my P&L or my profit and loss. It's all really your income statement. And again, your profit and loss statement, it measures your revenues and expenses over a period of time, generally monthly, quarterly, or annually. And it tracks the profitability, whether the business is making a profit on what it sells. Okay? So what's the difference between a budget and a P&L statement? Isn't a budget basically dealing with your revenue and expenses? A P&L statement is also dealing with your revenue and expenses. That's the same thing, right?
Well, the budget's looking at the future, profit and losses right now.
That's exactly right. Your budget is projecting. That's your future. That's what you anticipate or you hope to be able to achieve. Your P&L statement, your income statement, is your historic numbers, is what you actually are able to perform. And so that's very important that history helps us establish the future. Okay? So what makes up a profit and loss statement? I kind of like this tap and go.
It's kind of, it's pretty cool. The first night, we didn't even know it worked like that.
Yeah?
Once you get it going.
Yeah, they got the slides out of order. Flip through this here. One, it shows how successfully you are in buying and selling the process that's managed. Yeah, it reflects your business decisions. It kind of tells the banker or some other third party, you should tell yourself how successful you were in the actual buying and selling of products. My grandfather, who grew up, in the Depression era, and shortly after the Depression era, got into buying and selling real estate. When do you think he made his money? At the time he sold it or at the time he bought the house? When did he make his profit? He realized his profit when he sold it, but he really made the money when he bought it. He bought it right. So the buying aspects of it is very key and very important. In this profit and loss statement, this income statement will help show you historically, as Kevin alluded to, of what's your historic performance of buying and selling. Are you profitable? Are you buying at the right prices and selling at the right prices? How well are you managing your businesses? It measures the ability of your business to grow and repay back the debt and support yourself. Most business owners make the mistake of overly managing revenues, right? I want to get bigger. To get bigger, I need to sell more. I may be a $10,000 company. I want to be a $100,000 company. I'm a $100,000 company. I want to be a $1 million company. And it just goes on and on and on. We got to grow, grow, grow. Successful business owners will generate the revenues. I mean, those revenues are important, but they're successful by managing the expenses. So what are they actually doing? Are they managing the revenues? No, they're managing the profits. Successful business people, yes, revenues are important. Yes, and some growth is, the proper growth and managing that growth is important. But the most important aspect for success of the business is to manage your profits, managing the bottom line. One example, I won't name names or business types, but it's a true fact that had literally a husband and wife type business. They were very successful. They were very profitable. They made a good living. They were, and I'll just throw out some numbers. They might have generated $400,000 worth of annual sales, and they probably netted. They netted easily $100,000 to $120,000. They made a good living for themselves. Worked hard at it. You know, working for yourself, you got to really work hard. It's not an 8 to 5 job by any means. Well, they got caught up into, you know what? Wow, if I'm 400,000 and I'm making 100,000, if I grow to $1 million, I'm gonna be able to make 250,000 because not only am I going to make the same amount of income on those sales, but I could do some things more efficiently. I could start buying, you know, my materials a little bit cheaper. I could, you know, start gaining some of those efficiencies and those synergies that a lot of people talk about. So they found and determined that they were going to become $1 million company, and they did. They were. They, within about 1.5 to 2 years, they were $1 million revenue company, and they made $15,000 a year. What happened? They were concentrating on managing growth. They grew, but they didn't really realize what kind of expenses. They weren't managing their expenses. And what happened is, they worked hard. Remember, a husband-wife business. They worked hard. But they worked hard. In order to generate enough sales and revenues to get to that $1 million level, they had to hire 4 people. Well, wait a second. 2 people was doing $400,000 worth of business. Now they got 6 people doing $1 million. Is that more efficient? No. You know, well, why is that? Who works harder, the owner or the employee? The employee's working for the Friday paycheck. They don't work as hard as the owner. You know, come Friday, that employee wants a paycheck, right? You don't give them a paycheck, they're not going to show up at Monday. Well, as an owner, they may realize that, well, you know, I can't get paid this Friday because I'm working on this job here. I'm not going to get paid till next Tuesday. So they don't get paid till they get paid on that job. They're flexible. Employees aren't flexible. What it amounted to is that the husband and wife was working even extra harder for the employees. The employees weren't working for them. They made less money, significantly less money on twice the size of the company. They realized that. You know, we've had several discussions and, you know, kind of, you know, talked through some things, and they made the decisions. The bank will not make your decision. The bank will never manage a business. But we share some numbers with you, some dynamics for you to consider so that you can make some good business decisions. But they downsized their company and were very successful at it. So we can't manage growth. Growth is important, but we have to grow for the right reasons and the right purposes, and be sure that we're maintaining that efficiency and effectiveness as we grow. There's another company that grew so quickly that they almost grew themselves into bankruptcy, and they were very profitable, and they continue to be very profitable, but they grew too fast, and we'll kind of go through that illustration hopefully a little bit when we get into the cash flow side. So keep that in mind, that growth is important, but it needs to be managed. So the P&L is the most important report from your accounting software program. And that P&L, again, is our income statement. It tells us how profitable you are. And profits are very important. We said that as the most important aspect of it. So who thinks that the P&L is the most important report in your financial statement? Kevin, that's good. Appreciate you being honest, because the other ones are afraid to raise their hands. 95% of business people feel like that the income statement outlining the profits and defining the profits is the most important statement. While it's important, the P&L statement is important, at the end of the night, I hope that you come to understand that the cash flow statement, the statement of cash flows, is probably even more. And so kind of keep that in mind. I'm trying to bait you a little bit here to, work through some of this framework that I have to create until we get to my passion, which is cash flow. So what makes up the P&L statement? Of course, we got the sales. That's our revenues. We all pretty well understand what that is. We have the cost of goods sold. Cost of goods sold generally is the cost of that inventory or that the raw material that you need to purchase in order to generate those goods that you're going to turn around and sell. A good example would be a restaurant. You sell this nice food and a nice platter, be it a hamburger or a steak or whatever. Well, you got to buy that that steak and that produce in order to create the meal. That cost is your cost of goods sold. You take your sales minus your cost of goods sold, and that equals your gross profit. Okay, and that's simply what gross profit is. And one thing that as a business owner you need to look at, each business is in an industry category. And that means that throughout the country there are like type of businesses of yours. And there's some standards out there, some financial standards. Gross profit is one of those financial standards. Picking on the food industry, a lot of times they say that the food cost shouldn't be anywhere between, 20 to 25%. That's an industry standard. Well, if your gross profit margin doesn't support that cost of goods sold of 20 to 25%, whatever the industry standard is, you need to try to figure out, well, why is it? Or do you have too much waste? Or are you pricing your product up high enough? Is your asking price too low? There's a lot of dynamics that you need to look into that. So you need to look at your gross profit and compare yourself to your industry in that regard. Then from gross profit, we subtract overhead or SG&A, selling and general and administration expenses. And if you look at the overhead or those costs, there's two main expense categories. There's a fixed expense category and a variable expense category. Does anybody want to take a guess at what would be a good example of a fixed expense category? Rent. That's a very good example. Very good example. Generally, a fixed expense is anything that's going to occur no matter if you open your doors or not, right? How about interest expense on loan? Rick's a great guy, but he wants his monthly payment when it's due. First of every month, he wants that payment, which includes interest expense, a little principal hopefully as well too. That interest, the rent. Sometimes it could be a salaried employee. If there's a salaried employee, they get paid a salary no matter if they're at work or not. It's where you get paid vacations from. So you got to understand those fixed expenses. Those variable expenses are directly tied to you generating those revenues. So your inventory cost. If you sell more, you need to buy more inventory to produce. You sell less, you got to buy less. If you have labor that comes in only whenever you're busy versus slow, so if you don't, you have hourly employees, that could be variable expense. We don't open up your doors, you don't need to bring anybody in. But you need to understand the difference of fixed expenses and what are your fixed expenses versus variable expenses. Because the bottom line is that you got to generate enough revenue in order to cover your fixed expenses no matter what. And I understand it's going to take some of those variable expenses in order to be able to cover that aspect of it. If you have a good knowledge of your mix of your expenses and what your expenses truly are, you could then back into, well, what level of sales do I need to generate in order to break even? If I'm going to be in this business, and if I'm going to have this building and this debt obligation to Rick, and if I'm going to, do this type of business, I'm going to have to generate $15,000 a month in revenue. $50,000 a month in revenue. I mean, it could vary based on the size of your company. And obviously, once you subtract your overhead and SG&A, you come up with net profit. Most important thing there is, net profit, right? Right? No?
What does SG&A stand for?
I'm sorry?
SG&A?
That's your selling, general, and administration expenses, is what that stands for. That's basically your operating expenses. A good example of operating expenses also are, like I said, your rent, your insurance, a lot of times your labor, your utilities. I mean, anything that your business has to live, what do you have to live on? And that's those supplies and items as well too. Okay, profit and loss statement still. So again, kind of just to recap here real quick, sales represents the total amount from selling your product or services during the current time period. Sales are also known as revenue or income. Your cost of goods sold is the total expenditure for inventory items which customers buy. Okay, true or false? If a business owner spends $250,000 purchasing inventory instead of $200,000 in inventory, does the cost of goods sold increase by $50,000? If we bought $250,000 worth of inventory instead of $200,000 worth of inventory, does your cost of goods sold increase by $50,000? True or false? False. False. Everybody on false? False is probably the better answer, but the real answer is maybe. It's maybe. So what we need to do, we need to know what makes up the cost of goods sold. What's the formula, and how do we calculate the cost of goods sold? So that the formula is that you start with your beginning inventory, and when you say beginning, it's the beginning of that period of time. So let's just say your inventory as of January 1st, and then we're going to add to that all your purchases throughout the year. Then we're going to have to subtract off the ending inventory, and then that net difference is actually your cost of goods sold. So let's see if we can look at a couple of examples. Okay, so example 1, we have beginning inventory of $100,000. We have our purchases of $250,000, but we have ending inventory of $125,000. So $25,000 more in ending inventory. So you take that equation, your cost of goods sold is $225,000, even though we paid and bought $250,000 worth of inventory. Does that make sense? Do we need to back up a little bit on that one? That's an important dynamic, to understand really what your cost of goods sold and how to calculate that. As a banker, and hopefully as a small business owner, and more importantly as a small business owner, which of those two examples is better? Generally speaking. Now there's a lot of dynamics, and we're still very high level, we don't know a lot of the details, but just looking at those two examples, which one would be a better position to be in?
Sure, I say the second one.
The second one. Even though our cost of goods sold is exactly the same, we'd rather be in that second scenario, wouldn't we? And the reason for that is that it looks like, on the surface, again, this is high level, we don't know the details, but it looks like that business owner is managing their inventory levels a little bit more efficiently. They're actually, their core inventory is somewhere, it could be even less than 75,000, but it's less than what the first example is. And it looks like they may be managing their inventory levels more so. Managing inventory. And I'm getting ahead of myself a little bit, I apologize, but cash flow is so exciting. Right, Rick?
Yes, sir.
He's been on too many of the committees that we sit together in with me. You know how excited I get about cash flow. What does it take to finance that inventory. It takes cash. It takes cash. You gotta get that cash somewhere, either out of your pocket or Rick's pocket, but or Kevin's pocket. But you gotta come up with the cash. Is it easier to come up with $75,000 worth of cash or $125,000 worth of cash? You want to manage that turn. You gotta have enough inventory to stay in business and be consistent with your business, but you want to be as lean as you can. You don't want any excess inventory because it takes cash to have that excess inventory. That is so key.
Okay. When it comes to this stuff, I'm totally lost.
Okay.
So just say we start off with $100,000 worth of TVs,
Mm-hmm.
and then the plus purchases will buy $200,000 more
Mm-hmm.
of TVs. And then after your period's done, you end up with $75,000 worth of TVs.
Mm-hmm.
That's what you're saying.
That's right. That's
Okay.
exactly what I'm saying.
And then that cost of goods for selling those TVs you sold, or is that
Your cost of goods sold during that year is actually $225,000 because you not only sold the $200,000 that you purchased, you also sold $25,000 worth of TVs that you already had on hand before you started your sales.
All right.
Where in the first example, you bought $250,000 worth of TVs, but you really only sold $225,000 worth of TVs because your inventory actually increased. So what you need to figure out is, hey, in order for me to maximize and not lose the sale because I can't run out of TVs, well, but what's the fewest number of TVs do I have to have in inventory and still maximize that revenue opportunity? That's your core inventory level, and that's what you want to manage to. And again, it gets to be a lot more dynamics, to that. And I got some other examples, and I get ahead of myself, but I'll go ahead and share one. I got a customer who sells batteries. Okay. And one of the components in the battery, the key component of the battery, is lead. All right? Well, lead is a commodity. What I mean by commodity, price fluctuates daily. And in his situation, he was able to manage and maintain his cost of goods sold, but it made sense for him to come into the bank and say, you know what? In 60 days, lead prices are going to double. So that means that that battery that used to cost me $30 is going to cost me $60. I'm currently selling that, battery that cost me $30 for $50. I cannot increase my prices in my batteries, from $50 to $90 in 60 days. I said, all my customers will leave. It's too. I said, I can over a period of time. But if I do that in 60 days, that's too big of a pricing shock to my customers. I'll lose my customers. But I gotta protect my cost of goods sold. So in his case, it made sense to come in and get a short-term loan, and guess what? He stocked up on his inventory. He bought way more inventory than he really needed for that period of time, but he didn't buy any more inventory that he needed that he couldn't sell out over a course of a year. I mean, he didn't get totally crazy. But he actually stocked up his inventory, took advantage of those lower cost batteries, and was able to actually improve his gross margin. Because again, the gross margin is the difference between your revenues and your cost of goods sold over the 6 month to 8 month period of time, during which he systematically and slowly increased his pricing point, as in that battery that he sold for $50 to $90. And he was able to maintain his customer base because he also went out there and communicated to all the customers, hey, now's the time to sell buy batteries, lead prices are going up, prices are going to go up, now's the time to buy them. Well, he systematically increases the revenue slowly over a period of time versus that big spike. But he took advantage and understood this process right here, and knowing that, hey, lead's a commodity, and took advantage of a short-term loan in order to hedge against that increased prices. But inventory, TVs, you use that as an example. What if you stocked up on computers? I heard this morning one of the employees there at the bank is complaining because her son is wanting this PS4, and his little new game station, upgrade's going to go out. costing like $450 for that. Well, what do you think happens to PS3 once PS4 goes out? It become obsolete. This little computer, this little smartboard, it's pretty high tech. They become obsolete. So if you buy 4 years worth of smartboards and try to sell them, what's the, one, you're going to be out the cash for a long period of time, but what happens to some of your inventory if they go obsolete, if it becomes obsolete? It's useless. That's a dead expense. So you have to manage that inventory. You need to determine and use your budget process to know what your core inventory levels need to be and keep them at those levels. Don't get buried in inventory. People have a tendency to love inventory. It takes cash to finance that inventory. Cash is important. Cash is key. Profits are important. Cash is key. It takes cash to finance inventory. Manage your inventory. Manage your inventory. So when we look at this, and we talk about cost of goods sold is an income statement category, right? We kind of went through that. But we're throwing in inventory. On your financial statement, which again, your financial statement is a combination of your balance sheet, income statement, and statement of cash flows. Of those three statements, where would you generally find inventory? Do you find inventory on your income statement? Where would you find your inventory?
Purchase.
You purchase some, but on your financial statement, that's a balance sheet item. That's an asset. And we'll kind of go over that here a little bit as well too. So again, I'm just kind of precursing, the good stuff to come yet. But this is the first example where we're actually looking at a balance sheet item that's related to an income statement item and the effects that each of them have. Another main mistake as a small business owner is that we get hung up on profits. We get hung up on that income statement and we forget all about the balance sheet. And if you give up on the balance sheet, there's no way you're going to get to the cash flow level. And that's where we want to get. We want to get to the cash flow level. So kind of keep that in mind. This is our first illustration of actually using a balance sheet category, be it the inventory, and tie that to an income statement category, be it the cost of goods sold. Very important. All right. I think we already went over this. Next slide. And defining what gross profits were, what SG&A was, what net profit is, and how we calculate it. So what do you use net profit for? And I would want you to start thinking really cash flow. Net profit's important, but we want to start training you thinking cash flow. What do we use net profit for? That's how, if you're a sole proprietorship or an LLC, that's how you make a living, hopefully, right? You want to work hard, but you want to live, right? You don't want to have to work for Kevin and still operate your business just for the fun of it. That's not fun. You want to be able to live off of it. You also need those net profits for future expansion and equipment purchases. Plan for that growth. If you borrow money from Kevin or Rick, you better pay them back. And the principal portion of that loan has to come from the profits of the business. And everybody's favorite thing to do, right? Everybody get excited here because net profits, you get to pay income taxes. Who's excited about paying income taxes? Who wants to pay income taxes? Okay, there's one person. Why are you so excited about paying income taxes? I don't mean to put you on the spot. You're making money. Well said. I couldn't have said it better. Matter of fact, I said right here, no one enjoys paying income taxes. However, having to pay income taxes is a good thing because you're profitable and the ongoing success of your business is more important than having to pay taxes. Now, there are some legal means of managing your taxes, that you need to sit down with your accountant and go over with it, but there's a huge opportunity cost for small business owners. You either get yourself profitable enough where you're happy about paying income taxes and you get that loan to help you grow and expand continue to be successful, or you don't pay any income taxes, but then you're not gonna be able to support the ability to repay back any type of third-party debt, and therefore you're gonna have to grow on your own, and that's a lot more challenging. So there's a bigger upside to the proper growth and future benefits of paying income taxes than not paying income taxes. So I know it's tough, it's hard. You know, we all love to do it, but you know, we definitely need to pay our income taxes. So profit and loss statements, you know, how do you compile that statement? And it's fairly easy. You know, you go out there and find a software packet, you know, a Quicken, or you know, they got several different systems that will actually try to automate that for you. You use technology. That's the best. You know, it's pretty straightforward, and whatever you're comfortable in using from a system side of it. But start tracking your revenues, start tracking your expenses. Use that for your management type of solution. All right. So in your packet should be the second page, I'm assuming. Should be on the top, looks something along this line. It says a sample profit and loss statement. And everybody want to take a look at that? I'm going to ask you some questions about that, but everybody kind of take a look at that. And by looking just at the statement, that's all we're looking at, what do you see about this business? What type of business is it? What type of industry may it be? Is it a manufacturer, a wholesale, service business? What does this tell you what type of business it is? Hold on to that one. That's the next one, actually. Two more. What is this? A service business? Is it a manufacturer? Is it a wholesaler?
I'm gonna say it's retail.
It's a retail, which is correct, but a lot of times we refer to that as a service, because the landscaping business is providing a service. They're going out there and cutting your grass for you. You know, banking is a service. We go out there and provide, you know, financial solutions. So it's a service business. We need to kind of understand that, because you know, depending on the industry type, we need to look at things a little bit differently. So it's important to know that this is a retail or a service type of business. In your opinion, does a business appear to be well managed? It's kind of hard to tell, you know, but you know, they generated $68,000 worth of gross revenues. You know, they got a 35% gross profit margin for this industry. That's, you know, that's probably okay, maybe a little low, but not bad. But they're actually making a little money. They're making $14,000 a year. So, you know, making $14,000 on $68,000 worth of revenue, that's not bad. It's small, but it's well managed. There's nothing wrong with it. Does any problem stand out to you, Lisa? You know, this being, is there any nature to this business? I'm trying. It is a seasonal business. Well, what do you think is a seasonal business?
Because landscaping is usually done around.
You don't plant your flowers in January? What's wrong with that? It's very seasonal,
I
right?
put up that tree.
So that means that, yeah, exactly. So they have to generate that $68,000 in revenue probably in a matter of 5 or 6 months, 7 maybe. You know, it's very seasonal. So yeah, we need to understand that. What about the growth potential? You think there's any potential to grow? Kevin's shaking his head yes. Seeing a few other nods. Yeah, I think so. You know, especially with the net profit margin being about 22%, the way it kind of calculates out to be. You know, they are profitable. It seems like they're well structured, and you know, they don't have a lot of capital to grow with yet, and it would be my estimation because of limited net profit. But yeah, I think they could modestly grow their company. I don't think they could turn this into $1 million company next year. That definitely won't work. But you know, based on that growth aspect of it, they want to become a $100,000 to $125,000 company next year, and the business supported it, and they reinvested those earnings to that growth. I think that's practical. Will the business support the owner? Does somebody live off this business? No? Kinda hard to in today's times, unless you're a single person that likes macaroni and cheese all year. Lives with your parents yet, maybe, I don't know. But yeah, $14,000 is kinda hard to support living. So that's gonna make it even an extra challenge, because that means that this business owner probably has a part-time or full-time job elsewhere. They're probably doing this, actually, not these particular numbers, but I know somebody who worked full-time, and he and his son did this in the evenings and weekends, and was very successful. Got tired of it after 2 years and sold the business. It was a lot of work. But yeah, this is a part-time business, meaning it doesn't really have the revenue or the profits to support that owner's living. Will this business be able to get a loan? Put your banker's hat on. You gonna lend money to this business based on what you see? This is just one of the 5 C's. I don't think I gave them the 5 C's in this discussion. But yeah, probably so. I mean, a small loan. You know, they want to come in and borrow some money for, you know, some equipment. You know, a Z-turn or something along that line, or maybe a little trailer to haul their equipment. Yeah, you know, a small business loan. So this is a pretty sound little loan, but this is kind of an example of the, you know, of an income statement, and what you need to kind of be looking at and answering the questions to yourselves as your own business owner. You ask yourself these same type of questions, and then go a little bit further, saying, "Ooh, hey, there's a gross profit margin of 35%. How can I increase that to 45%? Can I buy something a little bit more efficiently? Can I buy something a little bit more timely? Can I increase my, in this case, hey, I'm getting $50 for this yard, well, I'm probably be able to start getting $70 for this yard." You ask yourself those hard questions, is what this whole example is about. All right? Rick, when it comes break time, yell at me, all right? I'm about ready to have a whole lot of fun. Cash flow. All right.
Let you get started on that before we go to the
Huh? Let me get through some basics. We'll cover the basics. You give me another 5 minutes, all right?
There you go.
All right. Well, there's actually 3 definitions on how you could define cash flow. The first one is basically the amounts of cash received less the amount of cash paid out over a period of time. Okay? You're actually moving, or, hang on here, or you're moving cash in or out of business, all right? It's all cash. That's what I'm talking about, cash. It's all about the cash. And the best one that I like the best is actually the net effect between sources and uses of cash between the balance sheet and the income statement. Okay, going back, and I'm purposely repeating myself here a little bit, but it's an important concept. When we talk about financial statement, we got a balance sheet, we got income statement, and we get a statement of cash flows. How do we get that statement of cash flows? Is that we merge and look at both the balance sheet and the income statement collectively. And that creates your statement of cash flows. So the sources and uses of cash between the balance sheet and the income statement is very key. And after this section, please, 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 take away the understanding that while profits are important in generating positive cash flow and knowing the effects of your cash flow is vital, a lot more important. It's all about cash. Can you pay me back through profits? You pay me back with cash. All right? And hopefully there'll be a better understanding of how, while profits are important, that helps with the cash flow, there's a lot more dynamics to that. So, I want to do first off, and then we'll do this and we'll take a break. I mentioned a balance sheet. We got basically a left and a right side of the balance sheet. All right? It's a perfect rectangle with two equal halves, right? I.e., they have to balance. That's what they call it, balance. So what has to balance? On the left-hand side, we have assets. Assets is anything that you own that has a value. Personally, that could be your house, your car, your checking account. On the business side of it, it's your cash that you have on hand, your checkbook balance, your receivables, your inventory, your equipment, your bricks and mortar, your real estate. Anything that you own that has value. On the left-hand side is your liabilities or your debt, okay? Plus your equity. All right? So a balance sheet is your assets equals the sum of your liabilities plus your equity. One important dynamic is remember and think about every asset that you own is financed. Okay? You have to finance every dollar of asset that you own. When we hear the word finance, what first comes to mind? Finance by taking out a loan, right? A loan is a liability, right? This section right here. All right? Every asset that you own is financed. You could either finance it through a loan. You got to pay back Rick and Kevin now, okay? And they're great guys, but we live off that interest that you pay us. So you know that's the cost of that debt, that financing aspect of it. Or you could finance those assets with your equity. Okay? So even though if you go out there personally and you buy a new car, and even if you pay cash for that new car, you're financing that car with your equity. You're still financing it. You got to come up with those resources in order to buy that car. So if the balance sheet has to balance, assets equals liabilities plus equity, which is a stronger person? And generally speaking, if somebody has this amount of debt with this amount of equity, is that a more or less desirable position than somebody who has something like this? This is better. It's better for you to finance those assets with your dollars versus the bank's dollars, that third-party creditor's dollars. We want you, as bankers, and this is a true statement, you could argue, but it really is. It's a bank rather have you finance your assets than we finance it, because if we're here for the right reason, we want you to be successful. The more the equity that you have, the larger that you grow your equity, the more successful you're going to be personally as well as business-wise as well too. Another quick rule of thumbs, and we'll take a break, and we'll start tying this all together into cash flow, is that on the business side of it, and I'm getting ahead of myself a little bit, but as a rule of thumb, about a third, about this level right here, for every dollar of assets you have on the business side of it, for every dollar of inventory, receivables, equipment, about a third of that needs to be your money versus the bank's money, as a rule of thumb. We'd rather have it be a lot more of your money, and over time, structured loans and hopefully reinvest those profits and ultimately cash flow in order to help move that line, that equity line on up. So, All right, so what, 10, 15-minute break, Rick? Is that all right? And we'll come back and we'll start getting into the good stuff. All right, cash flow projections. So what is a cash flow projection? A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of the business over a future period of time. A cash flow projection is used to see if projected sources of cash is sufficient to cover uses of cash. A business can be profitable and still run out of cash. Is that right? A business can be profitable and still run out of cash. Does that make sense? I'll prove, hopefully, that that is a true statement. It's a very true statement. I got a story that did not, well, it ended okay for the employees. It did not end okay necessarily for a business owner of that exact situation. So, who could tell me how a budget and its cash flow projection is different? And remember that budget, as Kevin correctly told us, is projecting out in that future revenue and those future expenses. And we talked about we really need to have that rolling 4 to 6 quarters. Always keep a year to year and a half ahead of yourself. And a cash flow projection, you know, it's still a projection, so it's not historic. I mean, it's still what we anticipate those future cash flows are going to be. How is that different from a budget?
It's just cash, it's not the overall picture.
It's just cash. And what did we say that makes cash? Is understanding that relationship between that income statement and that balance sheet and those effects of those two statements. The merger of those two statements creates this statement of cash flow. So that's exactly right, Kevin. The cash flow projection incorporates the changes and significant changes of the balance sheet along with your income statement. And that's very key. We also talk about and mentioned sources and uses of cash. So let's be sure before we get too far along that we understand a source of cash and a use of cash. And what we have to do, we need to try to keep it simple. Simpler is always the better. I oversimplify things. Don't want to get too complicated. Let's bring it back down to being real simple. So when we talk about sources and uses of cash, all I want to discuss about is how that affects the cash. Now we can talk about how we're using that cash somewhere else, but if you get a loan from Rick or Kevin, and it doesn't matter what you use that loan for, what does that do to your cash? If you receive a loan, is that a source or a use of cash? It's a source. So if you increase a debt, that's a source of cash. Okay, so now let's say that you got that loan, and so now you got a $10,000 loan. So now you have $10,000 worth of cash, because we're talking about the effects of cash, and you buy a piece of equipment with that $10,000. What is that? A source or use of cash? Use. So you're using cash to buy an asset. Roll your clock back a little bit, and when we were talking about the cost of good analysis, and we talked about the ending inventory, and remember that that cost of goods sold, we took our beginning inventory plus our purchases less our ending inventory. And in one example, we had more inventory, more ending inventory. The other one, we had less ending inventory. So if my ending inventory increases, that's an asset. So I'm increasing an asset. Is that a source or use of cash? I'm using cash to finance that additional $25,000 worth of inventory, that $125,000 worth of ending inventory. On that second example, I only had $75,000 worth of ending inventory, which was $25,000 less. So my asset went down. Is that technically a source or a use of cash?
Source.
A source, because I actually technically sold that asset and created cash. And that's, if you start thinking in terms of cash and the effects of cash, sources and uses of cash, that's why an inventory is so vital to control your inventory, because in that example, there's a $50,000 difference of cash financing that $125,000 worth of inventory, or that's $75,000 worth of inventory. When you're growing, well, I'm getting ahead of myself. I keep doing that. I apologize. But when you're growing, you had to grow that inventory to support your increased sales. If you don't manage that inventory, you're going to have to take more and more cash to finance that additional inventory, and that's the dynamic of your profits may not be large enough to fund and finance your additional inventory or maybe receivable type of needs. You're growing faster than what your profitability is. And we'll go through that in a little bit more detail. It's exciting, so it's hard for me to stay on track, so I apologize. All right, so, okay, I don't want to get ahead of myself here, so I apologize. So let's go back before I want to talk a little bit more about the balance sheet before we move on. So we come back here on the balance sheet side of it, sorry. And why do you think cash is always listed first on your asset? And usually after cash we have marketable securities, and we may have AR, we may have inventory, and then a little bit later down here we could have equipment, we could have real estate, we have all types of categories. When you're looking at the balance sheet, we always want to list the liquidity of that item first. When we say liquidity, is how easy do we convert that to cash? Cash is cash. You can't get any more liquid than cash. So it's always listed first. Marketable securities, and you may be invested in some type of stock, bond, mutual fund, but you could sell it. I'm not saying it's smart to sell it, but you could convert it to cash. Hopefully your receivables, if you're selling on a receivable, hopefully you're converting that sale to cash every 30 to 45 days, whatever those terms of those receivables. Same thing with your inventory. If you buy that inventory, you hopefully are able to sell that inventory and convert it to cash. Well, there's a line here that we want to draw. And up here we want to call that current. And down here we want to call that long term. We need to distinguish the difference between current assets and long-term assets. And we'll kind of talk about the same dynamic on the liabilities here in a little bit as well too. A current asset is anything that you could readily convert to cash within a year is a given term. So hopefully we could convert that receivable and inventory into cash within a year. Typically we don't, that equipment or that real estate lasts longer than a year. The functional life of those items are longer than a year, so that's a long-term type of asset. Same thing over here on liabilities. We usually have accounts payable. We may have accrual expenses. We may have current maturities and long-term debt. We may also then have a real estate loan and an equipment loan. Same dynamic. Those payables, if you go out there and buy some inventory, but instead of paying cash for that inventory, you're not going to pay for that inventory for another 30 days. You're creating a payable, but that's due within a year. That's a current liability. Accrued expenses. If you're accruing salaries and wages or vacations or something along that line, you want to recognize that as an expense as it occurs, so that's an accrued liability. You're going to have to pay that eventually within a year. The current maturities and long-term debt, what that is that on Kevin's long-term real estate loan, you might be making a $1,000 a month payment. So you're paying him over the course of a year is $12,000. Well, $10,000 of that may be interest, but $2,000 of that is the principal. So even though you have a $100,000 loan, let's say, if you're going to pay him back $2,000 worth of principals going to come due in a year, you'll show $2,000 being a current liability, because that's due within a year, and your long-term real estate loan is only $98,000. You still owe $100,000, but it breaks out that you're going to have to pay back $2,000 in a year and $98,000 longer in a year. So what cash flow is going to get into play, and when we get into working capital a little bit, is we have to compare your sources of cash and be sure that you can actually convert those in cash by the time your expenses and your payables and accrued expenses and your loan payments are coming due. So you're actually generating more cash than what your obligations are coming due. That's what we mean by balancing the sources and uses of cash. All right? Is that somewhat clear? I know it's confusing, and hopefully when we go through that, the black bulb will start coming on a little bit brighter. But I want to kind of show that we need to kind of keep that in mind, that structure on the balance sheet.
What's AP?
Accounts payable. So if I own a restaurant and, you know, the milkman comes and I buy $1,000 worth of milk, but I don't have to pay him for a week, I create accounts payable. I don't owe it today, I owe it sometime in the future. Okay, a cash flow projection is a good tool for setting sales goals and determining if you can afford growth and bank financing. It's going to tell you how your cash is reconciling after each period. It's going to also help you determine your break-even point. What do I mean by a break-even point? Yeah, how much revenue, what's my sources of cash I got to generate in order to cover all my expenses? That's exactly right. Very good. Planned equipment purchases and a replacement for expansion. You know, growth is good, and a lot of times we have to replace equipment or we might have to add on to it. But we need to be sure that we match that with our cash flows. We don't want to create a lot of overhead and not be able to generate the cash in order to pay for it. And we may need to know and determine what our cash needs are to purchase inventory for those seasonal cycles, right? Lisa likes Christmas trees, but you know, she might not have the cash to buy all those Christmas trees during the week of Halloween anymore. It gets earlier and earlier in order to be able to sell them, you know, and collect her cash from that inventory. She may need a short-term loan. She needs to know what her cash needs are in order to buy that seasonal inventory. And continuing on, it'll track your liquidity when accrual accounting masks cash realities. Does everybody know what the difference is between accrual accounting and cash accounting is? A great example, or a good example, I'm going to pick on Kevin here. If I am going to sell Kevin this water bottle, it's only about 70% used, it's still got some life to it, but I want to sell that to him for $1. Kevin, I want my $1 and I want to give you the water bottle at the same time. That's cash. I got cash for it. Okay? But if I sell, you know, Kevin, I'll sell you this water bottle for $1, but you don't have to pay me until next week. All right? You know, I know you can't afford $1. We get paid on Monday. Why don't you pay me that $1 on Tuesday and we'll be all right. Well, I've already delivered the goods and services, so I created that sale today. So in my income statement, I have a $1 worth of sale, but on my balance sheet, I have $1 worth of accounts receivable because I didn't get the cash. I financed that sale for him through my accounts receivable. So it's going to stay there as accounts receivable until he gives me that $1 back on Tuesday. So, and then when he gives me that $1 back on Tuesday, I don't create another sale, I just credit back down my accounts receivable. It's when you recognize your sale versus when you actually get the cash. That's an accrual accounting. I recognize that sale at the time I delivered as goods and services, even though I didn't collect the cash for it. So that's the difference. Most of the time, not all the time, I would recommend that small businesses deal with accrual accounting versus cash accounting. Because accrual accounting is going to better represent what your true profits are, and that's important when they're actually earned. Okay? It will help determine the need for financing, and we'll show that example here in a little bit. And it shows the lenders your ability to plan and repay financing, and that's frequently required on loan applications. even though it may be a misnomer, and collateral is important to a bank, we have to secure our asset, which is the loan, which is your asset being the collateral. But you know what? The bank is not in the real estate business. The bank's not in the equipment business. The bank's not in the car business. We don't want to take that back and foreclose or replevin or repo those assets. We buy and sell money. We agree contractually to give you a lump sum of money at a time, and we want you to pay us back a little bit on a monthly basis or a periodic basis, and we want you to pay that back over through your cash. And that's what your cash flow statement is going to help support your ability to pay back that loan. So that's why it's important from a loan side of it. So let's look at a sample here. So this is a cash flow projection sample. And at the top, it shows some sources of cash. All right, so that's all your incoming cash. It starts actually with your beginning cash balance. Then it has your cash sales. So if Kevin gives me that $1, that's a cash sell. Or if it's a receivable, I can't show that until I collect it from Kevin next Tuesday or next month if it happens to happen. That's the collection of receivable. But you see that top section identifies different categories of sources of cash. Okay? You can see that some of those are income statement driven, but some of those are also balance sheet driven. Because if you actually obtain a loan, if Kevin, borrowed, some money, Rick's going to require a down payment. So, Rick lent him 50 cents for him to buy this $1 water bottle. But if you receive some loan proceeds or a revolving line of credit or equipment type of loan, that's a source of cash. So you want to identify it. Along with if you have to put some equity into yourself. Again, if you finance that equipment by you transferring $1,000 out of your checking account and put it into your business, you need to reflect that. That business needs to count and stand on its own. So you need to account for the equity that you put into it. And then it identifies some uses of cash. And you can see there's some examples of some of those SG&A expenses, those operating expenses. And then below that, some non-operating uses of cash, like the debt service. That's your loan payments, the equipment that you may have actually purchased, self-employment taxes, your owner's draw, inventory purchases. And at the end, you'll have an ending cash. So it kind of, reconciles your checkbook for you. You start with a balance in your checkbook, you log in all your sources of cash, you subtract out all your uses of cash, and hopefully you'll have a balance on your checkbook at the end. Okay? In your handouts, I think the third one is a sample cash flow. So let's kind of look at that sample cash flow. That this cash flow tells us about the business. Maybe what are some ways that we could actually increase cash flow? One thing is that we could actually increase the number of items that we sold. So, beginning in that first period, we sold $4,800 worth of items. If we're able to actually sell more than that, that's going to help our cash flow. So, if we grow our sales, that's actually a good thing. We could also potentially increase the price. That would help our cash flow. So if we're selling water for $1 and we increase that to $1.25 and still could sell the same number of units, that would increase our cash flow. We could look at reducing some expenses. We need to be looking and trying to understand really what our expenses are and how efficient can we be. Do we need that amount of wages, or can we reduce our office supplies or our phone expense in this example? Look at your operating expenses. We can look at the timing of our expenses. If there's something there where our inventory, you can see that they're buying inventory every quarter, so it looks like they're trying to manage their timing side of it, but maybe it might be a little bit to their advantage. It'd be hard to say this, but it might be better for them to buy a little inventory every month versus once a quarter. As a banker, I'd want to kind of understand the dynamics of why they're buying inventory once a quarter versus monthly. But you could change your timing and maybe use accounts of payables. If you borrow money from Kevin, what's the first thing starting day one that he charges you? Interest. That's an operating expense, right? If I would sell this water bottle to Kevin and I finance that for him, it's accounts receivable to me, but it's accounts payable to him because he owes me this dollar. But I say it's okay that you don't have to pay me that dollar for 30 days. How much is he going to pay me at the end of 30 days? Generally that same dollar, right? So there's zero interest. So use of your vendors, your accounts payable people, that's free money. That's cash flow. Now we don't want to abuse your vendors because they can run you out of business quicker than any bank because they can say, hey, you don't pay me very well. Instead of paying me every 30 days, I want this cash on the barrelhead. COD, and that could adversely affect your cash flow as well too. But use your vendors. That's free money. Usually, but you have to have the cash so that whenever at the end of that 15 days or 30 days comes up, you have that cash in order to fulfill that vendor. But use that. And instead of borrowing money from a bank or something, you could save money if you have sufficient opening cash, some of your own capital into it. It needs to be a startup cash injection that can affect that. So again, looking at this statement, I'm going to bypass a couple of slides and try to get to what does this tell you? Look at your statement and tell me what's the maximum loan that you think they actually need as a starting business. They lose money for the first 4 months, or they generate negative cash flow for the first 4 months is a better statement, and to the point of a peak about 9,300. So yes, exactly, but they needed about $10,000 loan. What else could they have done instead of borrowing the money to cover that $10,000? Well, if they had an opening balance of $10,000. Well, if they did a budget and they projected this out and say, hey, if I'm really going to go into this business, it's better for me to invest my own capital, my own investment, that equity over there. It's probably better for me to put at least $10,000 start capital into it. I wouldn't need that in order before I can start generating positive cash flow. Do you think this business is just a straightforward business, or is it seasonal, or is it cyclical? What does this cash flow statement kind of tell me about your business type?
It's like it steadily increases.
Yeah, it steadily increases for the first 6, 7, 8 months. Then what happens in month 9, 10, 11, 12? So yeah, it kind of looks like, especially when you get that 18,000 in month 5, and I would call this a seasonal business. There's enough fluctuation there that this is probably a very seasonal type of business. Do you think that their overhead and their operating expenses are managed okay? And help you address that, let's drill down just a little bit further. Give me 1 or 2 examples of a fixed expense that you see here. Rent? Yep. Phone? What about variable expense? Contract labor, absolutely. Absolutely. Maybe even a little bit of the marketing, don't you think? If they're seasonal, they need to probably be marketing more in their on season versus their off season. And there's some fluctuations there. Why didn't the owner start taking money out until month 5, down towards the bottom?
Business to start making, want business to start making profit.
Yeah, they waited until they started generating cash flow. And more importantly, not even because it started generating positive cash flow in month 4. Would you agree? Because their beginning cash was, actually, I think I made a mistake. Probably month 5, because I think mine's off. What's your guys' beginning cash in month 5?
-39.
Negative what?
Beginning cash in month 5?
39 negative. 39.
Yeah, 3,900. So, and then in month 4 is a negative 9,300, right? So month 5 it started positive cash flow, but it wasn't enough to actually bring it back to a positive cash balance. But they started generating positive cash flow in month 5. How long, as a rule of thumb, would you think is their inventory on hand? How long are they maintaining their inventory? How many days? They're buying their inventory on a quarterly basis. That's exactly right. I'd guess 60 without doing the math. We can do the math and find out exactly what it is, but that's very good. Looking at the inventory purchases compared to their cash revenues, you think they got a pretty strong gross profit margin or not? That's actually, I think, very profitable based on, how quickly it's kind of rebounded and not only recovered the $9,300 negative cash flow peak, but ended the year at a positive $25,000 worth of cash. So yeah, I think it's, looks to me very profitable and well-structured business from that regard. But, the dynamics again here is it's actually looking at the effects of cash and finding out really what your cash needs are and when that you need that cash. One thing that's not included here that would help their cash flow, even though they're a cash-based business, you don't see any accounts payable. They're paying for that inventory at the time they order it. That inventory is still a cost, but they could improve their cash flow if they would maybe utilize their vendor and carry that over a 15 or 30-day period of time. That could be a source of cash flow. And if they did that, then that ending cash would probably be closer to 30,000 to 35,000 actually. By the end of the year.
Just a question here.
Sure.
That month 5 when the profits jumped for them and did so well, their marketing, they put out a lot more marketing. I don't know what type of businesses it is, but maybe that could help the other months as well.
Yep. Well, and you look at their cash sales, that 5th month was by far their best month. So something happened there. We don't know what it is. But again, using that cash really makes an important driver for you. All right, so let's start putting some of this cash flow to work. Let's start letting you guys take something home that might help you out here. This is all great textbook stuff. But let's jump on, we kind of covered all these items. Operating cycle. An operating cycle is defined by the number of days it takes to start with cash and end with cash. So I'm going to do a little visual here. All right? I want to ask, Rick is the business owner.
Okay.
Right? He's going to give me this cash. And with this cash, I want to go through the cycle of, hey, I got to buy some inventory. So I'm taking time, buying some inventory. I'm manufacturing, improving that inventory, making it into my commodity. I want to sell that inventory to somebody. And so, I spend $1 on that inventory. I'm going to sell it for $2. But I'm not gonna be able to collect it today. When I come all the way back over here, it's gonna take some additional time in order for Rick to get $2. And if he has a successful operating cycle, it's that amount of time it took from cash to cash type of basis. But if he's successful, he started with $1, and at the end of that operating cycle, he's now got $2, right? He's got positive cash flow. All right, I'm gonna keep my $2. All right,
I was
so
wondering.
let's look at that operating cycle a little bit closer. Okay, I'll actually come over here and refer to this later. So we start with day 0, and we come out this way, and let's say this is, you know, your inventory. And we make a sale here. We no longer have inventory, but we have accounts receivable. But it takes this amount of time to collect our accounts receivable. So let's say that takes us 30 days in order to make that sale. So we had our inventory on hand for 30 days, but it took us 45 days to collect the cash. So what's my operating cycle in a number of days? 75. You know, cash to cash is 75 days. All right? So let's see how this matches up with my. Yep. Well, I was right. Good. I hate it when I'm wrong. All right? So that's our operating cycle. All right? So it's going to take, and we got to find the financing, because what's happening to cash during this period of time? Or is this a source or use of cash? We had to buy inventory, and we didn't get, and we had to finance that receivable, and we didn't get the cash back till 75 days. So during that 75 days, did we use cash or generate cash? That's a use of cash. All right? So that takes cash, and that's not a good thing, it's a use. One thing that we could shorten that operating cycle with is through what's called a financing cycle. And really, you had that same circle, but you got a dynamic. I'm running out of chalkboard here. But you have your accounts payable. So let's say if we have accounts payable of 35 days. What's my financing days? Oops. 40 days? Right? Is that 40? My brain shuts off this time of year. Is that right? So 40 days. So was my accounts payable a source or use of cash? It's a source. So really, what I need to come up, and what we'll cover here in a little bit, is I need to cover and have enough working capital to cover 40 days worth of operations, right? Because it took me 75 days to start with cash and end with cash. But I was able to shorten that because I had some of that free financing out there through my vendors, through my accounts payable, to come up with a net financing cycle of 40 days. Seeing some blanks. This financing. Again, we take the operating cycle and you subtract off the accounts payable days on hand. And again, we talked about that's important to discover our working capital needs. And we need to we need to understand our operating cycle and our financing cycle, which is our true cash flow for the business and the balance sheet side of it. But we have to, if we're going to generate that widget, and if it's going to take us 30 days to hold it in inventory before we can sell it, and it's going to take us another 45 days to collect our money. So that's a total of 75 days, but we're going to be able to use our vendors for 30 days. Or 35 days, excuse me. We have to have 40 days worth of operating. Okay.
So you're saying use your vendors, you're talking about them basically extending credit to you.
Absolutely. That's exactly what they are. They're playing the role of the bank. But their cost of their funds is a lot cheaper than what the banks is,
Right,
because
they're
they
saying,
don't
okay, we're
charge any type of interest.
We're gonna give you these supplies, but you don't have to pay us for
Mm-hmm.
X amount of days.
Mm-hmm. So we'll Right, exactly. So let's get in and be sure that we understand that financing cycle a little bit more, and then we'll show you how to incorporate that into your working capital type assessment. So the next thing that we need to probably do is to truly understand that relationship I keep referring to is how the balance sheet and the income statement are really related to generate these cash flow statements. So let me see how I have this form. So we're going to look at what income statements are associated with the balance sheet side of it. So, you know, that accounts receivable, let's start with that. The accounts receivable is related to what income statement category? Well, what happens on the income statement whenever I generate accounts receivable? They're related, they're cousins out there. And we need to ensure we understand that relationship. Sales, there you go. So whenever I sold this water bottle to Kevin, I generated a sale. I didn't get to collect the cash yet because I created a receivable, but he's not paying me until next Tuesday. All right? So even though an accounts receivable is a balance sheet category, it's related to sales or revenue. Okay? All right? I had to hold on to this for a period of time. So this is my inventory. So I can't sell it to Kevin unless I have inventory. All right? Inventory is a balance sheet item. That's an asset. It's mine. I want to sell to Kevin, but I got to hold it in inventory. All right? So what happens to my inventory? How do I reflect that transfer of ownership from a balance sheet on the income statement? So if I take this away from my inventory, so I'm reducing my inventory, all right? Yeah, I created a revenue, but I have to account for the cost of this inventory. So what part of the income statement is that cost of inventory that I had to hold in order for me to be able to sell it to Kevin? What's that income statement category? Cost of goods sold. Absolutely, exactly right. Remember, to calculate cost of goods sold, we had beginning inventory plus purchases of inventory less ending inventory is your cost of goods sold. But Rick's such a good guy that he's a manufacturer of these water bottles. I bought my inventory from Rick, but Rick extended accounts payable for me. I didn't have to pay Rick for 20 days or 15 days, you know, so he financed it for me. So that's accounts payable. What income statement is accounts payable associated with? Cost of goods sold, absolutely, because it's still tied and related to financing the inventory. So that's exactly right. So we need to understand that from that regard. Okay, so what we're going to do now is that we're going to put you to work. All right? So in your little clip of forms, after your cash flow projection, you should have a little operating cycle example. Okay? And Bob owns an auto parts store and sells the majority of his parts to local mechanics. He asks that his customers pay him on a net 30-day basis. Bob is very aware of his cost and takes advantage of a 2% discount from his vendors. Based on the example below, how long is Bob's financing cycle and what is the minimum working capital Bob needs? Ooh, we're throwing in working capital too. We haven't even talked about working capital yet. So we're looking at Bob's statement, and the relevant information on Bob's statement is that he's got accounts receivables of $62,500. He's got inventory of $83,000, accounts payable of $20,000, revenues of $500,000, cost of goods sold of $300,000, gross profit then is $200,000, his operating expenses is $150,000, and his net income is $50,000. So those first three categories are all balance sheet items, right? Receivables, inventories, payables, and then below that it's all income statements, revenue all the way down to net income. So how do we do this? So our first step is that we got to calculate the days of on hand, it should be on hand, sorry, for the balance sheet items that affect the operating cycle. What affects the operating cycle? Are what we refer to as trading accounts. Again, our inventory, our receivables, and our payables. So how do we convert that to days on hand? And what do I mean by days on hand? What's the whole aspect of cash? We want to look at the effects of cash, right? So we start with cash and we want to end with cash. So based on our accounts receivable, we want to know how many days that $62,500 worth of receivables actually is associated with our sales. It's going to help us out quite a bit. Huh?
30?
No, but I think you're on the right track. But so if you look at that formula, so our accounts receivable days on hand, that's what that DOH stands for.
Oh.
You know, we start as a numerator is the $62,500. That's your accounts receivable. What income statement category is that accounts receivable related to? Whenever I sold this water bottle to Kevin, I generated revenue, right? So what is my revenue total? 500,000. So I don't know if anybody has a calculator, or you guys gonna trust me or not. But if you take $62,500, which is your accounts receivables, dollar amount of the receivables that you have on your balance sheet, and you divide that by $500,000, which represents your revenues, and we're gonna multiply that by 360. I know there's 365 days in a year. I didn't miss that day of school. But from an accounting side of it and a banking side of it, we really like dealing with 30-day months. Just a whole lot easier to figure. So we base a year of 360 days from that purposes. So if you take that difference and multiply by 360, that equals 45 days worth of receivables. All right. So he's averaging collecting those receivables every 45 days. That's $62,500. All right. So the inventory. So we got $83,000 worth of inventory. What income statement category is that inventory related to? Cost of goods sold, which is $300,000. So you do the same type of math, 83,000 divided by 300,000 times 360, that equals 100 days worth of inventory. So I'm holding on to this water bottle for 100 days. Well, I need to be talked to.
And if it goes past 100 days?
Huh?
If it goes past 100 days, that you're holding on to it?
I'm sorry?
If you're holding on to it for longer than 100 days, then you start losing.
Well, I'm probably not making a whole lot of money if I'm holding on to a water bottle for 100 days.
Right.
Anyway. But yeah, I need to work, you know, that's the first thing that I need to look at and say, hey, for my industry of selling water to people, how long does my peers carry their inventory? And if it's 100 days or 99 days or something along that line, well, that's the nature of the business, and so that's okay. But if my peers are being able to turn this inventory in 60 days, I'm at 100 days, then I got some cash flow management opportunities. I need to learn how to reduce my inventory levels. I may also have some obsolete inventory based on my inventory type. You know, you talked about, brought up TVs and the out 3.0 technology. We have to be careful. You got to look at your inventory, because some of that inventory that you may be building, you're never going to be able to sell because it's obsolete. You know, try to sell. You use the PS4. Try to sell PS1s. Are you going to be able to? It'll be really hard to. But what if you had $50,000 worth of inventory of PS1s? Was it worth it? And then you really had some losses. It's where you got to really manage your inventory. Inventory management is a key component of a successful business. You just got to keep sure you're turning it. You need to have enough, but not too much. Okay? So accounts payable, we have $20,000 worth of accounts payable. What income statement category is that related to? It's your cost of goods sold. So if you do the math, 20,000 divided by 300,000 times 360, that's 24 days. So step 2, then we need to calculate our financing cycle in days. So what's our inventory days on hand? what was that? 100. What's our accounts receivable days on hand? 45. And we're gonna subtract off our accounts payable days on hand, which was what? 24. So what's our financing cycle in days? 121, yeah. I gotta calculate 121. So again, what does that 121 days tell me? What is it telling you as a business owner?
You got 5 months to get it done.
You gotta find cash in order to support that. What level of cash do you need to support that length of an operating cycle? Because again, if an operating cycle is going from cash to cash, and then we're able to shorten that a little bit with the use of the payables, which is a financing cycle, but we're looking at trying to convert cash to cash, the bigger that circle, the more cash it's gonna take. If we can look at those numbers, and just like what Kevin alluded to, he said, man, that 100 days inventory is way too long. We need to shorten that thing down to 60 days. Well, the smaller and the quicker your operating cycle is, the less cash that you're actually gonna need. So you want to understand what your operating cycle is and do everything that you can to lessen that time of conversion from cash to cash. All right? So that financing cycle is 121 days. So then we want to convert that to, hey, how much cash do I really need to fund this business, to fund that financing cycle? And to do that, we got to take and divide your operating expenses by 360 days. So that tells us what our daily operating expenses is, and then we'll multiply that by your financing days. So what's our operating expenses in this example? $150,000. So if we take $150,000 divided by 360, that means we're spending, operating expenses wise, $416.67 every day. That's what it's costing us to open our doors, if we sell anything or not. It's costing us $416.67. We're going to multiply that $416.67 by the 121 days, and that equals $50,417. So if your trading accounts, your receivables, inventory, and payables match these totals, and this was your income statement, you would need to have $50,417 worth of working capital. Either you're financing it or the bank's financing it, just to have that size of business and that length of operating cycle. So let's say 24 days worth of accounts payable. That's taking advantage of that 2% discount. Well, what would happen? What is our financing cycle if we, instead of paying every 24 days, we didn't worry about the 2% discount and we paid 30 days? All right. What does that? So we're paying our accounts payable 6 days slower. What's that doing to our financing cycle? So let's calculate our financing cycle. Let's make it easy on ourselves. We still have our inventory at 100 days. We still have our receivables at 45 days. But now we subtract off 30 days worth of accounts payable days on hand. So now our financing cycle drops to 115 days, right? Because we use that free money, it's no longer really free because we lost a 2% discount, but we use Rick's money for an additional 6 days, and we've shortened our financing cycle to 115 days. Well, if you take that $416.67 a day operating expenses, now multiply it by 115 days, then your working capital needs goes down to $47,900. So as a business owner, you got to look at, is it really worth my while? We all like those discounts. We always like those sales. But are we actually saving enough cash in order to justify taking advantage of that 2% discount? That's a tough question. You guys are the only ones that can answer that one. You know, to me, in this case, you're flipping a coin, honestly. And I hate to pay 2% more, but you know, depending on what stage of my business is in, I might need that $3,000 more too. So that's how you can use this operating cycle and your financing cycle to kind of determine what your working capital needs are. So what's our working capital? Anybody want to guess what our working capital is? Our working capital is our relationship between our current assets, you know, again, all those assets that are readily converted to cash within a year, compared to our current liabilities, which is our obligations that are due to be paid within 1 year. So from a working capital side of it, we want to have more current assets than we do current liabilities. So what's enough? Well, we just stated here that this difference, right, in our example, needs to be at least about $50,000. So we can quantify that. And it's important to know that. Good rules of thumb is that for every $1 worth of current liabilities, you need to have $1.50 to $2 worth of current assets. That's a good ratio. Because Rick's a good guy, but you know, and he's financing that for me, but you know, he can't afford to carry me beyond 30 days. If I don't pay him within 30 days, he's going to come back and say, "Hey, Craig, I'll sell you those water bottles, but you need to start paying me COD." What does that do to your cash? That creates your financing cycle just lengthened by another 24 to 30 days based on whatever example you can. That means more cash that you need to come up with. So you got to take care of Rick. You got to take care of Rick before you take care of the bank. Rick being the vendor. They could put the squeeze on you a lot quicker than what any bank could be. Don't misunderstand that. Some bankers want to be big and tough and say, "Hey, you got to do this or else." Take care of your vendors, because they'll affect your cash quicker than anything. Okay? So, how do we improve working capital? There are really only 3 ways, mathematically, to be able to improve working capital. So we kind of come back over here again. And our working capital, again, is the relationship between this line and this line. These are current liabilities and these are your current assets. And we want to increase this margin between them. What's one way that we could do that? Again, everything is associated with cash. We want to kind of keep cash in mind. One way to do that, I want to erase this a little bit, is that we can sell this equipment and we can convert that to cash. Right? That's one way. Because then if you do that, we're taking a fixed asset and creating cash, which is a current asset. So this line moves down, it gets a little bit bigger. Another way to do it is that we could take some of those short-term debts and refinance them into long-term debt. If we're really growing quickly, we got to be really careful. I mean, I don't never say never, but I'd be cautious about doing that. I mean, because it's still debt. And if you can't pay the debt when it's normally due, and you need the longer terms, we need to be sure that if we do that, we structure it and you're in a position that you don't have to keep consolidating credit cards is a good example. Consolidating credit cards is fine, no big deal, but if you got to do that every year, you're really hurting yourself. So we got to be careful about restructuring and moving current debt into long-term debt. But that's a way to improve working capital. Because again, if you move it in here, that raises that line and improves it. The only other way to do it, and I'm talking about a business, So outside here, we got the owner. And we talked about earlier the dynamics that we need some capital. And the more capital that you have in the business, the better you position yourself for success. So it may be the point where the owner injects some cash into as equity, and we move that back into cash to use it as cash. So that's the only 3 ways to improve your working capital. Again, your working capital is your relationship between your current assets and your current liabilities, and that's a measure of how quickly you're going to be able to convert your assets into cash in order to serve those liabilities. And we need to have that as a positive margin, hopefully $1.50 to $2 worth of current assets for every dollar worth of current liabilities. And if that's tight, and you need to have your working capital, there's really only 3 choices that you have. Sell a fixed asset, refinance a short-term current liability, or inject capital as cash. Okay? So going back there, if you're a new business and you knew what and those were your projections, and you knew what your financing cycle was 121 days, and you need $50,000, it would be best if you could come up with, it'd be great if you come up with all of that actually, because that should be your working capital. All right? So that kind of helps to kind of determine and give you some guidelines of how your debt is properly structured. Okay, so in your handout, I went through like a ton of slides. One thing I do want to cover is sustainable growth. I mentioned earlier that if you're not careful, you can grow yourself into some financial stress. Growth is important, but we got to manage it. Understanding what you could finance or how quickly you can grow internally is very important. That's what sustainable growth is. It's a level of sales in which you can sustain and grow and still maintain what's called actually your leverage position. So that you don't have to go out to a bank and obtain third-party credit. You really want to try to grow within that, your own reliance. And there's a nice little formula. We won't get into that at 9 o'clock at night, but be able to refer to that. But that will tell you based on how profitable you are and your relationship between your fixed expenses and variable expenses of how quickly you could grow. There was a company that was directly associated with in financing. They had very strong traditional debt service coverage. Debt service coverage is a form of cash flow. From a banking side of it, for every dollar worth of debt service, your monthly payment or your annual payment, we want, earnings, what we call cash flow, which is your net profit plus your depreciation plus your interest expenses. We want, for every dollar worth of debt service, we really like to have $1.25 worth of cash flow. That's a good debt service coverage. That's your probably, if you get to operate in that area, that's a good rule of thumb. Cash flow is more important, but that's a good rule of thumb if you want to look at it from a traditional side of it. Well, this company was very successful from a traditional cash flow side of it. They were well over 2 times. They were generating $2 to $3 for every dollar's worth of debt service. They were going great on paper. But I was trying to tell the owner and trying to express to the owner that they're growing too fast and they don't grow, they don't slow down and moderate their growth and start collecting some cash, that they're going to run out of cash. He didn't understand, nor did he really believe me, unfortunately. And that went on for about 2 years. And it came to the point where he had to sell the business in order to keep the business going. Somebody had to come in and inject that capital and cash as part of the ownership of that business. And fortunately that happened, and that business is still around today and doing quite well. But what happened was that they were growing too fast. And you look at those operating cycles and understanding your trading accounts and how long you're collecting your receivables, how long you're keeping up that inventory on hand. Well, he's growing this way, real quick. His earnings are positive, but not at the same pace. Well, that gap of generating cash, he was needing to fund several $100,000 more to finance his inventory and his receivables than what he's able to generate. As a bank, the well isn't bottomless. We could only go a certain depth within that well ourselves and still make a sound business side of it. So, borrowing money from us wasn't the answer. He had to slow his growth down in order to generate the cash, let that cash flow catch up to himself, but he didn't want to. He was growing at a 20 to 50% growth rate every year for about 5 years. And he could not finance the increased need of carrying those inventories and receivables. He ran out of cash. Sustainable growth and understanding that. Now, is it okay to grow over and beyond the sustainable growth rate? Sure. But you want to do that over a short period of time and not an extended period of time. And you want to grow from the cash flow side of it. Don't grow like in an escalator, because that's what that company did. And it was a very steep escalator. You really want to grow in stair steps. And by growing in stair steps, every time you kind of flatten off and you manage that growth, if you're profitable and if you're generating positive cash flow, you're going to be generating some positive cash in order to actually finance that need of increased amounts of your inventory and receivables that you're going to have. You're going to be able to catch up yourself, maintain that sustainable growth side of, at least over a 2 to 3 year period of time. It'd be neat if you do it every year, but that's not real practical. But over a 2 to 3 year period of time, you need to stair step that and let your cash flow catch up with your growth. If not, you're managing the top line and not the bottom line with that. All right? And they got in your example, and I want to be appreciative of your time, but there's an example of really how the dynamics of what that happens. Well, let's go through that, and then I'll close up in a minute. So, for example, let's say sales grew from 500,000 to 800,000 per year. Gross profit was 35%. Receivables was 45 days. Inventory 100 days, and payables 30 days. What would happen in this case is that because your sales, remember, receivables are associated with sales, so if your sales went from 500,000 to 800,000, in this example, your accounts receivables would also increase by $37,500 and still keep that 45-day term. Just because you're a bigger company, you're going to have $37,500 worth more in receivables. Your inventory that stays at 100 days is going to increase by $54,200. So if we increase an asset, receivables and inventory, by that amount, some $40,000 or $90,000, is that source or use of cash? If we're buying a car, do we buy a car with cash or do we get cash? That's a use of cash. We're buying an asset. So we need to generate that cash. We're going to be able to finance, oh my gosh.
Just take the mouse and roll it back.
Oh my gosh. Sorry, roll it back.
Roll it the other way. There you go. We just tapped it, it was jumping.
So, on our payables, our payables are also going to increase, which is a source of cash. So we're going to have $16,200 worth of, source of cash. So our net difference, this business would have to generate $75,500 worth of net cash flow in order to have a sustainable growth rate. So if you look at your cash flow statement and your projection that we went over, if you can't generate more than $75,500 in cash flow, a positive cash flow, which means that's really going to have to come from earnings now because you're actually using cash because your inventory is growing and you're buying more and more inventory, is that you're going to outgrow yourself over a period period of time. Most businesses, not all businesses, when they start getting to that rapid growth level, what do you think actually happens to their accounts receivables and inventory days on hand? Kind of an example of my husband and wife business. If they grow too rapidly and they don't have the right management structure into it, they're not going to be able to collect the receivables in 45 days. It might take them 60 days to collect it. Well, now if you're at an $800,000 business company, and now you're not collecting your receivables in 45 days, it's taking you 60 days, that's going to mean that your receivables are going to go up even that much more. And that means that you're going to have to finance and cash flow even that much more. That need is going to go from 75,000 to 100,000, just like that. And so when you grow, you got to grow smart, and you got to be sure that you have the proper infrastructure and management structure that you can manage your growth. You're going to have it. You got to keep those receivables collected. You can't let your payables get out of hand. You can't build a bunch of obsolete inventory because you bought too many PS1s instead of PS3s. Something like, there's a whole lot of management aspect that goes in within those numbers. Because most companies, if they get in and if they start concentrating on growing, all they want is sales, they're going to lose focus on collecting their receivables and managing their inventories, taking care of their payables. Okay? It is now 9:10. You're probably more than tired of listening to me. There is some other sections which is part of your presentation dealing with some of the financing side of it. We kind of covered a big part of that when we talked about the importance of you injecting all the assets that are being financed. You have to finance part of that with your equity versus the bank's equity as well. There's also some ideas and programs of what kind of options that you have pertaining to needing to understand your financial statements and some of the loan programs that may be out there as well for you. Is there any questions? I want to make the right use of your time. I've already kind of gone beyond my time. Is it what, 9 o'clock?
9:30.
Was it 9:30?
I would bring the table. No, I'm just kidding.
Oh, okay. So I got a few more minutes. Okay, I thought it was already 10. I thought you told me 8:30. Don't stretch it beyond 9. I guess you just knew me too well. All right. So, but before we get on, the area, this information is good, and I would encourage you to read it. But I think you can decipher the remaining information out of yourself. Went through a lot right here, starting with the operating cycle and the working capital and financing cycle and sustainable growth. I really like to spend the remaining time answering questions. Make this so that you can take this home and start using it.
Okay.
All right, understanding.
The accounts receivable, you said we used 37,500.
Mm-hmm.
Where'd you get that number?
All right, let's calculate that out. That's great. Kevin, you got a calculator? Doug, Justin,
Yeah.
Ed, somebody, one of you? All right. Right now, we said that accounts receivables but let's back into what our accounts receivables actually were. So take 500,000 divided by 360 times 45.
62,500.
So when we had a $500,000 company, our AR was what?
62,500.
62.5. All right, we are now 800,000. So if we take 800,000, excuse me, divided by 360 days, so we got our daily accounts receivable balance, and multiply that by 45 days.
$122,222. 122,222.
Your math and my math is wrong now.
800,000.
I got it by taking the incremental difference. If your sales go up $300,000, divide that by 360 times 45, come up with 37.5.
Okay, there you go. Now, let's do this though. So basically, you're looking at the additional, so 62.5 plus the 37.5 is what?
62. Or it's 37 foot?
Mm-hmm.
100,000.
100,000, there you go. Okay, so that's assuming that accounts receivable stays at 45 days. So the difference is that 37,500. But what a lot of times happen is that if you're going to grow and you're not managing your growth, and let's say that your accounts receivable is actually 60 days, let's figure out what our accounts receivables actually would be in that case.
What was it now?
We're going to go to 60 days.
So 300,000.
133.
133, yeah, that sounds a little closer. 133?
Yeah.
So call it 133,000. So instead of increasing 37,500 here, if you still grew, but you didn't collect your receivables as quickly, you're going to use the difference between 133 and 62.5 is what? You subtract those two?
70,500.
70,500. You need to generate that much additional cash just to cover your receivables. But then you also have the same dynamic for your inventory. And if your company, on an $800,000 company, and let's say a decent company is a 5% net profit or cash flow margin, 5% of the 800,000, $40,000. You only generated $40,000 worth of cash flow, but you needed $70,000 to fund your growth. Where are you going to get the additional $30,000? You either got to get that from the bank, and that's just on receivables. I mean, you have to add your inventory. But you either got to get that from the bank or your pocket. And what you want to do is to understand what your projected cash flow is really going to be. Understand that you're going to be able to generate 40,000, and then instead of growing 800,000, you may only need to grow to 600,000. There's something less than that. I mean, you have to kind of do the math to see how much, and that sustainable growth rate will give you that percentage. Say, hey, I can afford to grow. If I'm going to generate $40,000 worth of cash flow, and based on my relationship between my fixed and variable expenses, I could afford to grow, 10%. Then, you know what? I better stop at 550, or I need to go seek some additional capital, either dig in my savings account or go get a bank loan. And getting a bank loan is fine short-term wise, but if you do the same thing over and over and over in multiple years, that's where you're going to get into some financial stress. The reality of it is that, you know what, this year, if you had the opportunity to grow to 800,000, that's great. Take advantage of it. Know that there's a cash flow shortfall here, let's say $30,000, but let's have that conversation with your bank and say, you know what, I took advantage of this. I had a competitor go out. I got this opportunity to get this, these other additional customers, and I did all this growth. But I need some financing need of this growth, and you know what? I need probably a 2 or 3 year loan because I want to save. I want to kind of cap my growth, and I want to try to save this cash flow, pay back that loan that finances growth, and then hopefully by that time I can find another opportunity to grow again. That's that stair-step approach. The reality of it is that for you to grow consistently 5% a year, that's neat if you can do that, if that's your sustainable growth rate, but that's not real world. That's not realistic. You're going to be able to grow 5%, 5%. Ooh, something out there in the industry and the market happen. I could grow 15% or I could grow 20%. Well, that's good. Take advantage of that. But don't go 20% for 3 to 5 years in a row or you're going to go broke. Take advantage of that 20% growth opportunity, but be willing to moderate and manage your growth over the next couple of years until your cash flow catches up with you. Once your cash flow catches up with you, hey, take the next step, grow some more, keep growing. You know? And what happened with that company that I experienced, he's growing like this, and his cash flow is like that. And we were able to finance that difference up to that point, and beyond that, you had to sell the company. You basically had to find somebody else to inject the cash into the company. And guess what they did? They actually got rid of some, what ended up being real not profitable clients, and they downsized the company. They managed their growth, cash flow increased, and they were very profitable. It took them about 3 years to get that point, but they injected enough capital to sustain that period of time. And they actually downsized the company and it was more profitable. Just because you're growing doesn't mean that your profits are going to increase. You can't you got to be aware of that top level that was revenues, but you got to manage your bottom line. You got to manage your profits, but more importantly, you got to manage your cash flow. And understand that balance sheet affects, especially on your trade accounts, your receivables, payables, and inventory is really that's where the cash flow is. You got to understand those dynamics and those changes right along with the effects of your income statement.
Right. Could you do us a favor and just kind of parallel that with, we have a lot of people in here that have a service industry, not necessarily an inventory control, and how that still is the same effect. You know, you managing your payables and receivables, and it's along the same line.
It's exactly along the same line. You may not just have some of the traditional accrual type of trading accounts, being the receivables, inventory, and payables. But yes, definitely, cash flow is even more important, honestly, when you're dealing with the service industry, because you don't have the reliance of those receivables. You just got cash. You just got your checkbook, and you can't, go to Rick and get some of that cheap financing. It's just not there. Where are you going to finance? You're providing a service. So the whole dynamics of the cash flow aspect of it, and that cash flow projection is even more important for a service industry.
So you would just do all of it without the inventory?
Yep.
I was gonna ask if there's.
Set the categories that are relevant to your business. And if you don't deal with inventory, good for you. Inventory is a killer. But it's still the dynamics of the cash. And you may have some receivables. I don't know what type of, but manage your receivables. And if you do have to buy some type of commodities, or you just got to be careful of timing your operating expenses out, and try and match those with your
If you're in the
receivables.
chiropractor business or medical field, you have insurance that you might be getting money. You have to manage those things. That's a type of managed payment that you're going to.
So you still have an operating cycle.
Right.
You still need to determine that operating cycle. You just don't have that inventory. You have that service rendered to, and you even actually have different stages. You might want to break your operating cycle down to the stages of, okay, yeah, I can get paid here, here, and here. And I might get 30% here, 20% here, and the balance here. You still have your operating cycle, but you want to kind of time your sources of cash based on the number of days and understand the effects of that cash flow, and then incorporate that into your cash flow projection. Yeah, an operating cycle is still important for you as well too. Just a different dynamic. And you're managing your receivables based on paperwork. Making sure they're keeping up with the proper regs, and if I don't hit this date, then I all of a sudden extended my receivables by 30 days because I missed a pay period. That's what I hear from some healthcare agencies. I gotta get that Medicaid or Medicare form in by a certain date or I miss a cycle. So yeah, there's a lot of management behind the scenes on
Well,
that.
actually, this is gonna be kind of just me, really, in reality.
Yeah.
It's just with attorneys and getting paid from them.
Yeah.
So, I mean, I won't have a whole lot of outside. But I'm assuming I still have to do the same.
Yeah. The one thing that was actually a little bit later on in the presentation we didn't get to tonight, but your business is the most important thing. The success of your business is what it's all about. And you, as a business manager, is the next thing. You have to have a vital idea. Have to have
To provide you with the resources to achieve and protect your financial success. And that's our vision, and this is part of it. And like I said, ask questions you want to. You know how to get a hold of us. And we look forward to seeing you next week.
Everybody
You
got
wanna
a jump
explain?
drive?
Yeah. What's
On the jump drive that you have is basically the blank Excel forms. You know, there's no, these are my forms, so I don't get paid a royalty. If they help you, please use them. You know, please change them and alter them to meet your needs. Or maybe sit down and with your accountant and say, hey, help me do this.
And our presenter last week, Luke, the marketing gentleman, and I'll have some information for you. He gave us some reading material, some resources, some reading material for you, and I'll get that to you probably at our next meeting. And so before you leave, you'll have something that you can also resource. As you can tell, he has no problem sharing. And Craig, thanks for all your input. And like I said, these are very important things as far as the business goes, and you kind of see it from our eyes and in general what it takes to be successful. Have a good evening. Be safe going home.
Thank you.